So I just wanted to make some comments on the development in the markets. I have primarily two aspects that I want to touch upon. One is some of the key fundamentals and the news reports on the economy that have come in the last few days, and then explain the reason for what we're seeing in the markets. In my view, the current developments in the markets are all related to global factors. I think if we actually look at the number of countries that have had a huge decline in their stock prices since the 31st of January. If we look at the period from 31st of January to the 12th of March, all these countries, Russia, Brazil, France, Germany, Argentina, UK, US, and Japan, all these countries have had more than a 20% decline in their stock prices, in the stock markets, and India is actually is below them. So firstly, what we are seeing currently is actually a reflection of some of the global factors related to the coronavirus episode. Now, what I want to actually point out is on various aspects relating to the Indian economy. First, the CPI inflation print that came yesterday. The inflation was 6.6% year on year, which is much lower than the consensus estimates. In particular, the decline in the inflation was because of the decline in vegetable prices. Earlier I had actually explained that the reason that the headline inflation was higher than core was because of food prices, and as we had predicted that we should expect the headline to start coming down in March, that has started happening. So by July, as I had mentioned, the headline should come back to core. Core inflation itself has also decreased from 4.2% to 3.9%. What is also very important to note in the context of inflation is that after 1.5 years of the rural inflation being lower than urban inflation, for both January and February now, rural inflation is actually higher than urban inflation, which means basically the purchasing power in the rural areas, is going up, which is actually good news, because the marginal propensity to consume or the effect on consumption is typically higher when the purchasing power goes up in rural areas. So that's on the inflation side. If you look at on the production, the IIP came in basically 2% higher, year on year, which is actually higher than much higher than the consensus of 0.5%. It was 0.1% year on year actually in December. This also correlates very strongly with the PMI, which basically for both January and February. January, in fact, was an 8-year high. And as I have mentioned earlier, the correlation of the PMI index with actual investment, industrial production, is high, about 0.6. So what we're actually seeing is the PMI index actually, which is a leading indicator, then correlating with the IIP. So that's something which is very important to keep in mind. Capital goods, the production of that, if you actually look at it on a month-to-month basis, seasonally adjusted, has gone up about 10%. So which is actually good news for investment, because investment depends significantly on the capital goods production. If you look at in terms of consumption, the consumer durables, if you look at the momentum there, again, if you look at on a month-on-month seasonally adjusted basis, for the third month consecutively, the consumption of consumer durables has gone up. So this is basically, these are inflation down, production, actually industrial production going up, consumption, rural side and on the consumer durables going up. Lastly, if we look at on the external sector, we now have about $500 billion of reserves. And if we look at by any measure, which is the number of months of imports that we can actually cover, or the number of, of amount of short-term debt that we can cover, there's absolutely adequate, foreign exchange exchange reserves. Even if you look at it, our current account deficit is actually about, April to December this year is 1% of GDP compared to 2.7% in the previous year. And given the decline in oil prices, we can expect the current account deficit this year to be significantly lower. So in other words, just to summarize, if you look at inflation, you look at production, consumption, and external sector, the domestic, many of these, these variables clearly point to some strengthening of the economy. So to summarize, what I would say is that what we are seeing over the last few days is primarily a reflection of global factors. And as someone who's actually taught finance, one of the first things I tell is my students is that stock markets oftentimes actually react both with greed and with fear. Currently there's actually some fear because of the coronavirus episodes, which given what I've spoken in terms of the fundamentals and the some of the macro measures, it clearly seems to be driven by global factors and actually some amount of the fear sentiment, which I would expect actually for them to over the next few weeks to actually come down as we get a handle. I think what is also quite interesting is that yesterday I read this news, and many of you would have also read about an Israeli Israel actually finding out a sort of a vaccine for the coronavirus. So some of those I think can also help in keeping this pandemic actually within sort of reach. So,
but does that mean that no relief will be coming from the government side, and the government will wait for more development on the coronavirus side as far as vaccines are concerned?
And there was an anticipation that government will come out with some relief on taxation, some relief for specific industries, new API manufacturing policy. A lot was in talks. Where are we?
So just take all the questions together. And so globally, we are seeing all the central banks also cutting rates. Do you expect the Indian Central Bank also to perhaps go ahead with it? And also, what kind of conversations you are having with the regulators so far?
This is apart from the dollars window announced yesterday by RBI.
So as as has been mentioned earlier, the government is seriously considering and looking at all aspects of this emerging situation, and the government together with the regulator will definitely be responding when it actually is necessary. What my point of emphasis here was to actually explain what is really happening, to give you an economist's explanation of why is it that the markets have reacted the way they have reacted. Bottom line being that the market reaction is not reflecting fundamentals, because as I explained using various sources of data, it is fundamentals actually are improving.
So, given the current
what kind of measures should we expect?
One at a time.
What kind of measures should we expect, and do you expect the central bank also to perhaps follow suit?
So this is something that actually is being thought through. The central banks, other central banks have certainly responded, and as I have actually pointed out, that the inflation data seems to be clearly suggesting that there is moderation in inflation, and as I had mentioned earlier as well, that by July we expect the headline to come back to core with the decline in the vegetable prices. Core inflation itself actually has gone down, and we would expect it to go down further in the future because of the decline in the oil prices. So I think there is scope for the central bank to consider these different aspects.
So with the current impact on the stock markets and the overall economic sentiment and economic activity, do you think this is going to impact our revenues and overall fiscal math?
So firstly, if we look at the and I've looked at the data compared to other countries. We have 70 cases so far reported, compared to other countries like Italy, South Korea, many of the other countries. Ours is at this point order of magnitude lower, and as you would have seen, the government has taken all the necessary steps.
Okay, the chief economic advisor there talking to reporters outside the North Block. And I think towards the end of that particular briefing, he did say to a question, he was asked whether the central bank would actually act and whether we will see something from the RBI. He said that, well, it is something which is being quote-unquote thought through. And he then quoted the CPI data, which is fallen by 100 basis points. and said, well, there is definitely room. And then he left it at that. But I think that is the next kind of thing to watch from a policy perspective here. I mean, it would have happened nevertheless. But will it be brought forward now? Will the quantum actually go up? Those are questions which we will need to see. Because, I mean, we got that consumer price inflation number yesterday evening. If the RBI had to act sometime this week, and if it wanted to wait for that CPI out of the way, well, we've got that now. And we've got the market where it is. So it's going to be interesting to see if they do come in. The market is recovering once again. It was down 100 points, basically from the recovery point, from the absolute recovery point. Let me just actually put these in numbers for you before we look at stocks. So the low today is 8,555. It recovered to 8,749. 8,749 was the high point. From there, the market sold off a little bit, almost 150 points. And now we are seeing some recovery back up again with about a 44-point cut from yesterday's close. So, as I said, as we were just discussing before we went across to the Chief Economic Advisor, this is not going to be one way up or it has been one way down well. But for recoveries, I mean, they're going to be sellers, they're going to be people who are shorted, who went long, all kinds of things. And there will be, people trying to clear positioning to get what they can out of the market, protect capital, that kind of thing. So it's going to be a zigzag road, one step forward, two steps back as we were just commenting a while back. But 20 points now, Surabhi, is the cut that we have.
I'll tell you who's cutting their short positions. Those who went short on IndusInd Bank, because that stock has seen a dramatic recovery and it's actually in positive territory right now. Even State Bank of India, some of these stocks are moving up quite rapidly and quickly. 9,740 thereabouts has been the recovery point, the high point. We're at about 9,575. We'll take your leave on that note, but don't go anywhere. Very quick break and all the market action continues. Halftime report up next.